Hi, everybody, and welcome back to the Business Transition Roadmap. We are here today talking with Eric Lake, who is the managing tax partner of SingerLewak here in Colorado. And I'm so excited to have Eric here. He's got so many years of working with private companies, helping them to navigate business transition from the tax perspective, of course, but also from a variety of others, just with all the knowledge and history that he has over the many years. So, Eric, welcome to our podcast today.
Thank you. I enjoy being here.
Good. I'm so glad we're here. So this is super fun for me. On top of Eric being the managing tax partner, he also is my brother. And I love being able to work with him at times and also tap into his knowledge. So he's going to be really, I think, super transparent with us today with some things that he has seen in working with clients and how they've navigated and approached transition. So, Eric, first, tell us a little bit about you and your history and your background as an accountant.
Okay, well, as you know, Elizabeth is my sister, and we grew up in Denver, Colorado, and I have not really left the state of Colorado to live for ever, really. So grew up in Denver, went to Colorado State University, got a degree in finance and real estate from the Colorado State University, and then I have a master's in accountancy from the University of Denver. I've been practicing as a CPA since 1992. Been in the accounting industry since 1989 when I was an intern with Coopers & Lybrand. I've gone through a lot of I started with a big four, went to a smaller regional firm. Then I started my own CPA practice in 97, bought a practice in 2002, ran that for a few years, merged in with another firm in Denver called Holben, Balzer, and that turned into Holben, Lake, Balzer. And then in 2019, Holben, Lake, Balzer merged in with SingerLewak. SingerLewak is a West Coast regional firm. We have about 435 people in our office, including administrative people. We are top 70 in the country in size, and we do everything from tax work, audit work, bookkeeping, accounting work. We have a company or a division that does franchising for franchise companies. We virtually do it all. We have a group that's international in nature. So a company that is going offshore or a company that's coming onshore, we have the ability to help them. And we also have a group called SALT, which stands for State and Local Tax. And all they do is state and local tax issues, determining how to best and most efficiently file tax returns and make your way through all 50 states.
Yeah, well, and
that's kind of our background.
Yeah, that's a lot. It's a great firm and a great group of people. And, I think that for our podcast today, you come at things from a couple different angles. One, in helping clients to navigate business transition. But second, you've been through quite a few business transitions yourself. So when you look at your clients and you see people starting to navigate business transition, trying to figure out how they're going to move the company from their generation, their current ownership, to a next generation's ownership, whether it's family or not, how do you see people starting to do that? What do they do?
typically what I see, and this is hopefully after they've kind of gone through what you can provide in the consulting, but typically where I see that happening is that the person that maybe started the business, or maybe even a second generation person at this time, they're kind of they're they want the business to thrive past their ability to run it, and they look to maybe their children or key individuals that are within the company, or both, really, in some cases, to kind of pick up that torch and move it forward. And often the biggest issue that we have from a tax perspective is what is the entity that is being transitioned. If you're talking about transitioning from like a father to one of his children, now we get into things like, are we typically those will be more like a stock sale, and that creates that's probably the best possible way for a father or a mother to get out of their business and get it to their children.
Tell people why. Yeah, what about that is the best way for a father or mother to get it to a child?
When you're selling stock, when it's a stock sale, all of the gain is long-term capital gains. Okay, as long as they've owned the company for more than a year, and that's obviously 99.9% of what we see. So all of it is capital gains from the seller's perspective, and that means that you get anywhere from 15 to 23.8% long-term capital gain. The difference between those two percentages is 15% is for something that's roughly less than $250,000 of capital gain. So mostly it's going to be up in the 23.8% range. And that's good for the seller. From the buyer's perspective, they kind of step into the shoes of the seller, their father, their mother, and so they're selling a company, and there's not a lot of depreciation and other, or they're buying a company, and whatever depreciation they have, let's say they have a bunch of old equipment, they're a manufacturing company and they have a bunch of old equipment, there's not really a lot of deductions for the purchase. There are ways that we can structure the transaction to alleviate that, but some of those strategies adversely affect the seller. And so it's really important to, when you're starting down this path, to get with your CPA, get with somebody like you, Elizabeth, and strategize and figure out how we're going to move these assets from one generation to another at the most tax efficient way and I'm talking about a father, mother, to their children, the most tax efficient way to move this to the next generation. And the tax efficiency is at the family level. The mother and father aren't taking a big hit, and the child isn't strapped trying to pay the bills. So and that's a really important thing.
Yeah, and that's interesting because what I see at times is I see people going for the how and how much, right? So they kind of start there sometimes with their advisors. And what I'm hearing from you, if I reflect back properly, is that it's important to know who you want to transition this to ideally, so that when you do go, so that you have a little bit of a foundation and you can go explore with a little bit more accuracy the tax consequences and also, some of the legal consequences that go around that. Because in prior podcasts, we've talked a little bit about stock sales, which, sale of the company with just sale of the stock or sale of the interest. We've also talked a little bit about asset sales, and asset sales they're different, and it's where the assets get sold out of the company, and then the company either you can do something else with it or you can dissolve it. The interesting thing is what you were talking about with your thoughts are tax efficiency, the best way to go from parent to child in a tax efficient manner. Because other people, they'll talk about gifting and other things like that. So let's say you were to gift to somebody versus sell the stock. Is the gifting strategy better in a way, or how does that compare to what you just talked about?
So that gets into the realm of a lot of estate planning issues. It depends on how big the sale is and what the parent has done in the past as far as gifting is concerned. You can definitely gift you could gift any company, all the stock, et cetera, to the child, and that would be very tax efficient today. All right. As long as the sale isn't, $50 million. Because if the sale is too big or the gift is too big, say more than $20 million, or 25 million, now we get into the fact that you're going to gift off all of these assets or these interests to the child and create a 40% tax rate to the mother and father because they have to pay the gift tax on it. All right.
Okay.
If it's a $12 million sale and there's a mother and a father, you could gift it, or $12 million value, I should say. You could gift it to the child or children and basically use up a bunch of your gift tax exemption and transfer it to the children virtually tax-free. All right. Now, when I say virtually tax-free, we haven't really gotten past the tax. All we've done is moved the stock or the assets or whatever you gifted to the child. They step into into your shoes from a tax perspective. And so if they were to sell the company, 3 months later, whatever capital gains that they have or that was transferred to them that was deferred, they would then get to pay. So they don't get what we call a step up in the basis of those assets. That only occurs at death.
Right.
So probably the most tax efficient way to do it is to hold on to the stock. All right. Create maybe some sort of a profit sharing plan for your children that they can share in the profits of the company. And there's ways to do that depending on the type of entity you have. And then at death, you transfer the actual shares of stock to them, and you can use your $12 to $13 million, depending on when you die, to shelter the capital gain on the sale of that company.
Right, on that transfer, because the key to that whole conversation, well, a couple of things that, takeaways is the step up happens with current law. If I'm reflecting back properly, step up happens with the current laws at the time of death, and it does not happen before. So correct. Holding on to that stock, if you're going to gift it, potentially is one strategy that might be workable. One of the things that is lost in that, one of the things that's lost in that strategy is the ability for the successor to create wealth for themselves. And so that's where that profit sharing comes in. So they can take some of the proceeds out of the company as though they did own it. But the actual transfer of the equity value takes place later.
Correct.
Yeah. So
Correct. And if you're talking about something like an LLC or a partnership, you can actually create they're called carried interests, and the parents can gift carried interests or profits interests in the partnership at a $0 value, because all you're giving your child on the day that you give it to them is the opportunity to make money in the future as a partner. So you're giving them a 3 or 5 or 6 or 15% profits interest, and it doesn't have a value on the day that you gifted it to them. Okay. And the only way that there's value there is as you make money in the partner, as the partnership makes money and they issue a K1 to the child will pay tax on that, and then they can build their capital account and their stock basis in the company over time. And their gift is the amount that they're paying tax on every year through the K1. So, and that actually it dilutes the parents' interests, and it's a way to shift money.
That's great. So we've talked a little bit in the past about just the need to potentially start with what I call the 4 W's: the who, the why, the what, and the when. And I think, whenever, in all honesty, when I start talking to Eric and also other tax people, there are so many things to keep in mind when you're thinking about the tax efficiency of any transition. You're trying to figure out, what type of entity do you have currently? How would you like to get it transitioned, and to how many people? And sometimes they're partners, and so that strategy is a little bit different tax-wise than maybe to a son or a daughter or a family member. And then so many different ways to get them going. The other thing I think that's interesting is there is always, and I'm finding it's getting bigger, the age of the people who are the current owners, they're living longer and working later in life, and they're having a good time doing it. And then the successors, who would normally be their successors, are older, because, especially if it's a parent-child kind of a thing, they're about 25 years or so apart. And so if the father or mother works until they're 70 or even 80 sometimes, and it doesn't give the successor the opportunity to create the wealth that they want to. And so I think that in the strategy, if you're putting people first and taking care of people, it's important to think about what happens to the successor and how they create their wealth, and also learn about the tax opportunities that are there for them.
Correct.
So I'm sure you've seen a little bit of tension in that area.
Yeah. And the piece that I think is that we as tax professionals don't really think about too much unless, you're in the middle of it, is, what does the father or the mother want out of this? There's a retirement piece to this that we don't really talk about. And so we have to figure out what the parents need out of it.
Or even a business owner that's transitioning too, right? Whether they're parents or not, what do you need? What do you need to retire?
Yep. Exactly. What do you need to retire? And that's a huge, huge issue. That's probably the biggest issue that I'm going to call him the seller has, is, I've worked all my life to build this thing, this money tree, if you want to call it that. And now I need to start harvesting some of this for me, but I want somebody else to help me harvest it. And so we've got to get that in place. As far as the successor is concerned, and some of the tax strategies for the successor is, is there a way that we can defer some money out of the corporation for their retirement? All right. And that's building their wealth so that when they get to the age of the seller, they have the ability to pass the corporation along, or the business along, and they may need about as much as the prior seller has, because we've developed a strategy to basically pull some of that money out and put it aside for them, so that they have money to live on, irrespective of what the business is worth. And that's really important.
Yeah, I think that's great. So I have two questions for you. One, how many of the clients that you work with that are private business owners, so they could be families or non-families, either way, but private companies, how many of them have a well-diversified asset base? So, not all of their money is in the company. What would you say?
I would say that it's probably close to 50-50.
Yeah.
Well diversified is kind of a moving target, because if your company is making net income of $300,000, the amount that you have to have outside of your company to be, quote, well diversified is a lot less than a company that's $50 million. And so it's kind of a moving target. But
you mean from an asset standpoint, that's true, but from a life standpoint,
from an asset standpoint,
it's the
from
flip.
a life standpoint, it's
flipped.
It's exactly right. If your company isn't making very much money, you better have a lot stashed away if you can.
Sure. Yeah.
Because you're just not going to be able to get the money that you need out of it to survive. Whereas if your company is a $50 million company, you're probably going to come out of the transaction with a lot more money than what you would have in other investments.
Correct.
So, yeah.
Yeah, that's very interesting, because most statistics are that 80% of business owners' wealth is typically tied up in their company. And the other thing about it, how
I would
often,
believe that.
Yeah, it's amazing. How often?
Yeah.
Well, and to that point, business owners, when they're building their wealth, tend to invest in the thing that they know best and the thing that they do best. And so you reinvest in your business and reinvest and reinvest and reinvest, thinking that you'll be able to cash it out sometime. And if you're intentional, I think that that's absolutely possible. And that's why also I like the timeline idea, because I was going to ask you, how many owners, or what do you think when you look at owners that are thinking about transitioning, that kind of know what their business is worth and also understand the tax consequences of if they go to sell to a third party or to someone else, maybe even a partner?
I would say that the number of people that actually, say 5 or 10 years out, start to look at the value of their company and try and figure out what their company is going to be worth on the day they retire, and they're 5 or 10 years out, I would say that's a very, very small number of people, really small. It's sad, but that's probably the case, because entrepreneurs, I think, are kind of a funny breed. They invest in themselves. They invest in the fact that they can get whatever they're doing done, and sometimes they don't worry about the future of their retirement when they're looking at their business per se. They're more interested in running it and being there and doing what they do best, and that's running that business. And those decisions are hard and maybe sometimes even painful to think about. You know, it's kind of like selling your first child. You just don't want to think about that. You know, so.
Well, there are a lot of relationships that are inside of the company that you care for as an entrepreneur. And
Yep.
The other thing, I think you're right, Eric, can be kind of sad because it is the end of an era in a way. It's the end of you as the entrepreneur building and growing. It could be the beginning of a next era of you being a mentor, teacher, helping somebody else to take it forward and letting go. And it also could also be the beginning of your next adventure. But some people don't want to do that. And I was talking to a potential client the other day, and there's nothing wrong with having a 20-year timeline where you're going to hang on to some of the assets, right? You're going to hang on to some of the stock or whatever it might be, even until you pass. And my belief is as long as there's a strategy for your family to know what to do with the business, whether they're taking it over or whether they're going to sell it and transact it to somebody else, as long as there's some kind of a strategy and people know, I don't think there's anything wrong in continuing to own it until you're no longer on the planet. It's just my belief. So,
I personally think that having that first or second generation person around, and it doesn't have to be that they're in the middle of it when they're in their 70s or 80s, but I love the fact that Bill Holben and Craig Hay, who are they're now my retired partners, we still have offices for them. They still come in occasionally. They still help us and consult with us on some of our client work. And they're just there. And that's part of that mentoring and passing it along. And so I thoroughly believe in people, that first or second generation, holding on to a little of that of the business and being a part of it. I think it keeps them vibrant, and I think it allows the next generation to move into those management and leadership positions in a little slower manner than I sold this to you, it's yours now, and good luck.
You're out of here. Yeah. Well, and that does.
I'm going to the Bahamas.
That's right. So, in order to do that, Eric, and you do have a great track record with that, and thanks for sharing that. It does require that you're able to keep the relationships intact. It's no fun to be in an environment where the relationships are tense and that. And so it's great to be able to keep the relationships intact and walk through it together, right? Both the leaving generation and the incoming generation. So I have two more questions for you. That will be at our time.
Okay.
So what do you see as the number one roadblock when business owners start to think about creating a transition strategy or leaving their companies? Number one roadblock.
I think the biggest roadblock I've seen is I think the biggest roadblock is the fact that this was their baby. This was the thing that they did really well. All right. And a lot of the really successful people that are entrepreneurial, all right, they did something that they were passionate about. And now all of a sudden they're in a position where they're going to try and liquidate that position, all right, so they can retire. But it leaves a hole in their day-to-day life.
Yeah.
They just maybe don't know what to do with themselves. And that's a scary thing. and they're afraid that whoever they turn it over to may run it right into the ground.
Both big
And
fears.
that would be tragic. What?
I said both really big fears and valid fears, right?
Yeah.
What's the owner's next adventure and what's going to keep them fulfilled? And then what happens if you leave that and you leave it in somebody else's hands, and then the whole thing is run into the ground, as you said, or just falls apart just because of the lack of knowledge and leadership potentially with the successor. And I think the longer the runway you give yourself as a business owner to walk through the transition and to stick around with your successor, the more likely your successor is going to be able to run it. It's a long learning curve to be able to do what you've done, especially if you've done it for a long time, 10 or 20 or 30 years. You've got a lot of history under your belt, and it takes a long time for the successors to figure all that out.
That is true, and quite honestly, I have a retirement time that's kind of mandatory in our practice. And I was just talking with one of my administrative people, and I've identified a couple of my younger leaders, and I'm working with them to get them up to where they can take my place. All right. And this has been going on for a year that I've been doing this, and I still have another 7 years until I have to retire. So the goal is I want to work myself out of a job, literally.
That's great.
I want to be able to step off the big ship onto my little boat and go do what I need to do. And it may mean that I have to work till I'm, 78 as a contractor for them, or, not 78, but let's say 70 as a contractor for my firm, so that we can get this transition worked out the right way,
That's awesome.
And I'll enjoy doing it.
That's awesome.
So,
okay. So last question. We're at our time. What one thing, if you could leave it with our listeners and our audience, what one thing would you recommend for them to think about in their transition, their business transition?
One thing. I think the one thing that they need to think about is who is on their transition team. Both accountants, lawyers, consultants, and the people that you're transitioning to. That's your transition team. And you've got to make sure that those people are rock solid.
Yes, thank you. And all pulling in your direction too, right? They're all on your boat.
Yes.
They're all on your team. Yeah. Well, good. Well, Eric, thank you so much.
If they're not, they shouldn't be on the team.
Yeah. And on that note, there are quite a few business owners that think that they've got the right people, and the team is telling them what to do, and they have an advisor that keeps on pulling them out of where they want to go as an owner, And so thinking about it is so important that there's harmony with your team. There's harmony with your successors and all of your advisors, and that you're all moving in the same direction. So if you feel somebody not doing that with you, Eric's right. They should not be on your team. Absolutely.
Yep.
All right, Eric. Well, thanks again for joining us. And I so appreciate you taking the time to be here.
Thanks, Elizabeth.
It was awesome.
Thank you so much. I look forward to it.